Hi, and welcome to Midas Investing. Today we're going to be taking a look at Mastercraft boats, ticker MCFT, which under its flagship brand is one of the fastest selling and high market share companies within the high performance boating segment, though it also sells within other segments under its Crest and Aviara brands. Let's take a look. Please subscribe to the channel, hit the notification bell, and smash the like button. It's the easiest way to help with the YouTube algorithm. If you'd like to be part of the community, join the free Discord. If you really want to show your thanks and support, there's the PayPal as well as the Patreon, where you can get access to private discussions, early content, and even your own link to my dashboard for looking up my valuations. All links are in the description below. Hopping right into their second quarter results, which it says their second quarter, but it's worth noting that that's actually the quarter they reported after the December month, because they do have a little bit of a mid-year fiscal schedule. One of the first slides that they actually point out is their CEO and chairman, Fred Brightbill, being on the call. And I point that out in particular because actually after this report came out, they made a release that he actually intends to retire. Fred was the CEO and the chairman of the board, and he's retiring from both positions at the ripe old age of 71. He's going to be replaced by Brad Nelson of Oshkosh Industries. He was particularly ahead of the commercial segment at Oshkosh, which, if you're not familiar, is a manufacturer of specialty vehicles. So I do think there's a decent amount of overlap in the type of business that it's operating there. Nothing to do with naval vessels in particular, but the idea of specialty vehicles, especially commercially focused specialty vehicles, I think at least gives a decent amount of overlap in terms of that selection. Another interesting thing about this replacement is that they are also going to be taking one of the independent directors of the board, Roque Lambert, and make him actually the new chairman. So they're actually going to be splitting up the CEO and chairman role, which in general is often a pretty good decision in terms of trying to get a more shareholder-friendly board and separating out the decision-making process a little bit. Going back over to the slide deck, one of the other things they do in one of the first slides is they talk about their three main segments, that being Mastercraft, Crest, and Aviara. Mastercraft does make up the lion's share of their business in total, with their focus on high-performance speedboats that are used primarily for the ski and wake sport. This, as I mentioned before, a very, very fast-growing segment within them and brand in general. Also relatively high margin for the boating industry as well. And they have a relatively high market share, about 20% or so, which is pretty good for such a small company. Their other segments are largely focused on pontoon boats sold under the Crest brand, as well as high-priced luxury day boats under the Aviara brand. We'll get into some of the discrepancies between the segments when we get into the charts that I put together from my model, but they are trying to grow these segments pretty significantly, though these particular segments are really a much smaller market share within their own respective spaces, anywhere from like 1 to 2%. Though these are also much larger segments to be in. So that's one thing to kind of keep in mind, is that a relatively small segment within the boating space, they have a relatively high market share, and then that segment is relatively high, fast growing, versus some larger, more established segments within the boating space that they hold a relatively small market share in. And those are newer brands that they are going to be able to potentially grow in. So there's a little bit of a different type of strategy, both in terms of the markets that they're targeting, as well as the potential for growth within them. Coming down a little bit further, they talk about the differences that they had on quarter over quarter within the second quarter report, as well as the year-to-date results in regards to that. The real main kind of takeaway that I kind of want to point out here is that they, like many other boating companies, as well as really just luxury discretionary product companies in general over the last few years, have seen a lot of rebalancing in terms of their revenues and well as their margins. These are relatively, as I was just saying, discretionary products. You really don't buy a boat unless you have a lot of extra money on hand, especially if you're on more of the wealthier segment. And so with the raise in interest rates, that's made a lot of people have to refocus their incomes, and therefore have to kind of rethink whether or not they want to spend money on such relatively expensive products. And then that has a pretty large downstream effect on the fact that these boats are not sold directly by the company. They're usually sold to dealers, which then have their own inventories. And so you kind of have to wait for a little bit of a bullwhipping on the inventories from the dealers, so that eventually, once those inventories are cleaned out, they come back around to make more purchases from Mastercraft themselves. But they seem to believe that the dealer inventories are starting to really get cleaned out. In the second quarter, they still had a pretty significant drop in terms of their sale from the previous same quarter of the last year. However, the dealer inventories themselves were starting to move back upwards. Coming down to take a look at those results, you can see both in the net sales and the unit volume down very significantly in all three of the different categories, though a little bit of variance in terms of which ones are being more highly affected. For example, you can see the Aviara brand down to 28 in unit volume relative to 34 is a little bit of a smaller drop off versus the approximate halving for Crest, and not quite having, maybe more, a little bit more than a third for Mastercraft in terms of the unit volume right there. Net sales obviously would be affected by the pricing level within that as well, and that's on the quarter over quarter. You can see somewhat of a similar type of result when you look at the year to date levels as well. They also talk about their capital allocation framework. Definitely one thing that I found very attractive about this company, the high returns on invested capital that they get. They do have a little bit of a lopsided kind of capex cycle. It seems to be that they can go several years with having very, very minimal levels of reinvestment, and until eventually there's a year where they have a decently larger spurt of reinvestment, though relatively small still compared to some high, more capital intensive industries. So with that capital efficiency, they then are also well positioned to return excess cash to shareholders. They do have a share repurchase authorization currently in place. About 41 million was available as of that most recent quarter. Though it's worth noting that they had that authorization in place since July of last year and only used about 10 million since that particular place. So they're a little bit perhaps slow to use their authorization, but they certainly do have it. So coming in to take a look at the model that I put together for the company, there's a decent amount of working parts to this, especially since they do give a pretty high level of detail for each of those three different segments that allowed me to essentially build up the cash flows for each of those segments a little bit separately, which I really appreciate, but it does mean that there's actually a lot of detail that I don't really have the time in this video to try to go through and fine tuning. But at the same time, I was able to put together a lot of good charts that I think will help paint the picture exactly of what I'm doing here. In terms of thinking about like how the revenues are going to grow for the company, I'm largely resorting to a lot of industry reports that I found on the overall growth of the various segments within the space that they're operating under. I found some reports from Mortar Intelligence and GMI in terms of the total global recreational boating segments, as well as from StratView, a performance boating segment growth rate, as well as for the pontoon boats, GMI and Market Research Future had a report, and then the luxury boats, there's GMI and Fortune Business Insights. So where I had multiple reports to go on, I essentially tried to average out the expectations over the timeline over the next 10 years for each of those spaces. And then I'm looking at the market share that the companies had over the last couple of years, because it's really the only ones that I can compare them to for each of those reports, and then try to grow relatively respectively in terms of that, keeping the market share generally in line, allowing a little bit of variability within that. Then I was able to back this up also against their own the company's own report of the market share they have and the overall market size that they're going for, which is a little bit more of a combined number, which was a little bit more useful because then I could actually look at that in terms of over the whole last 10 years of the historic data. And like I said, I'm building up my revenues from the industry reports, but then once I got to the endpoint, I kind of came back to double check against the own reported number to see how much the market share would change in terms of that. So getting into the charts, I'll kind of explain exactly what I mean by that. This is according to Mastercraft, the overall industry that they've been targeting over the last 10 years, approximately speaking. And then this is kind of the end result that I was talking about in terms of where I saw them growing. It's worth noting that this isn't an immediate jump. This is a jump forward 10 years approximately over this. And then you can see the three different points in time for the bearish, base, and bull case for my revenues. The purple line here showing the actual share that the company had over the last 10 years. So you can see that their market share, according to Mastercraft's own estimates, went from about 2 to 3% over the last 10 years up to the most recent couple of years of about 5% and change. So coming back over to take a look at the individual segments based off of the industry reports, as I was just talking about. First, we'll disaggregate the revenues within the Mastercraft segment into both units and prices. They report both for each of the segments, which is quite useful. You can see the units over the last decade grew pretty consistently from about 2,500 units per year up to a little over 3,000 in 2019. Had a huge dip in 2020 for obvious reasons, recovering 21 and 2022, sticking around these relatively cap points that we saw over the last few years. So the overall ability to sell was about 3,000, 3,500 approximately between that space right there. And then the price per unit also had a pretty consistent growth over this entire decade, as you can see right here. So jumping forward in terms of what I see over the next 10 years, I have them at a midpoint. My base case, them only getting up to about 3,800 units. So that is a little bit of growth from the last few years right here, but it's significantly less growth compared to what they had in the last decade. So I think that's a pretty reasonable conservative assumption to come up with. In my bear case, about 2,900 units, and then the bull case about 4,800 units. So I'm projecting the potential for them to grow pretty significantly, but you can see for the most part, we're actually assuming relatively moderate growth comparative to what they had over the last decade. And then likewise for the price per unit, we are assuming essentially in the base or the bear case that they're going to stay consistent with where it was right here, which means, in like real terms, if you were to think about that, what type of inflation we would have over those few years, it would actually sort of be cheaper in real terms. And then a little bit of growth relative to that over the base case, and more growth in terms of the bull case. I did want to kind of comment on the overall pricing in general relative to each of these segments. You can see that they're currently selling at a little bit less than $150,000 per unit. So pretty expensive products, as I was saying before, very discretionary in that sense, but especially kind of want to compare that with the other segments themselves as we move into them. But before we do move on to the next segment, we're going to talk about the overall revenues of the company. So the bars here are actually essentially taking those units as well as the prices, combining them together to actually see what the revenue of the company was over this entire time frame. And so you can see the revenue grew from about 160 to a little under 200 million for those couple of years, up to the last couple of years over 450 million. So very, very significant growth over the last decade. And then likewise over the next decade, you can see the type of growth that I'm projecting right here. So for a base case, we're really assuming significantly less than the more than doubling, almost tripling that we saw over the last decade, but closer to about that tripling in the bull case. And then actually we're seeing a potential decline in revenue for the Mastercraft segment in the bear case. Now here we have OpEx less depreciation, so mostly the cash cost, but not precisely that, but something approximating that over the last decade as well. You can see that it was a relatively high 80%, coming down over the whole decade, which is very nice to see that we saw a pretty consistent downward trend in that regard to the high 70s for the last couple of years. And then likewise for my projections, in the bear case, we're going to assume it goes back up towards more like the mid 80s. And in the bull case, we'll assume that they kind of maintain this upper 70s% for the operating expenses. Down these lines down here below, we also have the depreciation for those years. Depreciation in this particular case is actually as a percent of the assets, because they also do report the assets, but I'm not actually showing that on this particular chart. I do kind of make projections independently for each of that. And then CapEx as a percentage of sales. So you can see, however, that the CapEx as a percentage of sales and the D&A as a percentage of assets is actually relatively close to in line with each other, and that partially has to do with the consistency with the ratio of assets to sales that they have over that time frame. Though, like I said, I'm not actually showing that information here. But the point is all these combined together can get us both our operating margins as well as our free cash flow estimates for this particular segment. Now coming over to Crest, the second of their segments, here we have the units as I was showing you before, as well as the price per unit for each of the years that they have. Unfortunately, they've only been selling these particular products in this brand since 2019. So this is what we have for that. You can see that they went from 2,000 units, a little bit less than 2,000 units in 2020, up to almost 2,500, a little over 3,000, and back down to a little bit less than 3,000 in 2023. But still decent growth over this time frame, especially in terms of comparing it to the drop that everything of these types of products had in 2020, and then also growth in the price per unit pretty consistently over these few years as well. So my projections are kind of similar in terms of the types of stuff you saw for Mastercraft themselves, potential drop in the overall unit sales in the bear case, whereas a relatively leveling off, maybe slightly higher comparative to the peak levels we saw in 2022 for a decade from now. Keep in mind that's a decade from now for the units sold in 2034, and potentially a raise to a little under 4,000, which would kind of continue the trend upward, though at a slower pace over the next decade in the bull case. And then similarly for the price per unit, we're kind of assuming a leveling off, which would be a decline in real terms for the price per unit in the bear case, to potentially a decent raise in the price per unit that would be relatively commensurate with inflation plus for the bull case. And then likewise, I kind of want to comment on the different pricing, whereas the Mastercraft was a little under $150,000 per unit. we're at closer to $50,000 per unit. So these boats, the pontoon boats, are about a third of the price on average relative to the high performance boats that they sell in the Mastercraft segment. Now, coming over to take a look at the cost for the Crest segment, you can see here the operating expenses less depreciation and amortization. In general, they stay kind of around the high 80s for this particular segment, but we did have a pretty large jump up to over 150% in 2020 as they were still trying to sell many of these products at essentially a large loss. Now we're trying to be relatively conservative in terms of how we're dealing with the pricing. I'm trying to be a little bit more bullish in terms of thinking about the revenues, and then a little bit more conservative in terms of thinking about the costs. And you'll see how that plays out in the valuation. I think that really leaves a lot of room for, as they show strong and more consistent performance going forward, to give upgrades to the stock relative to the valuation I'm going to give them here today, which is a much, I think, more conservative way to approach a very discretionary product, as we were talking about before. So essentially, in the bear case, we're assuming that by 10 years from now, they're potentially still having difficulty selling them for a profit, with operating costs at over 100%, and then perhaps it drops more to like mid 80s under the bull case, and then likewise with the depreciation amortization relative to the capex levels, kind of similar to what we saw in Mastercraft, that they actually are pretty leveled off against each other. And then likewise, we'll use that projecting into the future. And that compares against the overall revenue, which was really a combination of the last graph, as we saw, the units plus the price per unit sold, potential declines in the bear case versus very, very significant levels of growth in the bull case, and then somewhere in between that for the base case. Coming over and take a look at the AVR segment. This segment was developed in-house and is definitely still kind of revving up in terms of both its market share as well as leveling off a lot of the costs. And perhaps as they start to get to larger amount of scale, they'll have a big effect on things. You'll see what I mean in just a moment about that. But here, the units sold, you can see going from 42 units up to 100 units up to 134 units over the 3 years that they've been selling. And so in terms of thinking about like where that's going to go over the next decade, it's definitely a little bit harder to project. But as I was kind of just saying, this is a brand that's really still just trying to rev up in terms of its actual growth potential. So in even the bear case, we're assuming still a significant level of growth over the next decade, but that would be actually a relatively disappointing level of growth compared to the growth opportunity that exists for these high luxury boats. So in the bull case, we're assuming a much stronger level of growth that's pretty a little still slowed down, but a much more comparable level of growth compared with what they've had over these last 3 years. And then our base case obviously being somewhere in between that. Consistent with the last two segments, however, the price per unit we're seeing, we're generally just kind of assuming a leveling off in the bear case segment, which is a little bit less than $400,000 per unit. And then the bull case assumption will be having a kind of a continuation of the inflation plus kind of levels of growth in the pricing, with our base case coming in at about $500,000 per unit. And with that, kind of commenting on that, you can see right here around $400,000 per unit, or a little bit less than that for these units. These boats are a couple times more expensive than even the Mastercraft boats. So you can see that in the Mastercraft segment, we kind of have the more mid-tier pricing. I say mid-tier for boats that are a little bit under $150,000 each, but they're made to appeal to a wider audience, considering that they're more about sporting. Whereas the Crest boats are much more about general uses on the water, pontoon boats. They're a lot cheaper, much more ease of access to a larger segment of the population. Whereas this AVR brand is definitely strongly a luxury brand, so definitely a little bit more focused on high income segments of the population. Going over and take a look at the cost for AVR, a little bit even more chaotic than it was looking at the Crest brand. I can see that the OPEX less depreciation, even over all the years that we have so far, unfortunately, is higher than 100%. This is still essentially a loss leader. As I said, a growing brand. They're kind of hoping to perhaps get to eventual scale where they can start to actually turn a profit on these bad boys. Well over 120%, 150% for the first 2 years, and then though coming down pretty significantly to be only about 105% OPEX less depreciation as a percentage of revenue in 2023. So still selling at a loss, but it definitely has the potential to become a real winner in that regard. Now, this is the thing where I'm actually going to be very, very conservative in terms of trying to make my valuation for this, because there is a lot of potential for this brand to become very, very profitable for the company. But I don't really want to rely on that, especially considering they have never turned a profit on these boats yet so far. And it is an in-house developed brand, and we're in an inflationary environment. And we are also higher interest rate environment, and it's a little bit hard to say exactly when it's going to happen. So even full 10 years from now, I'm still assuming that these guys are going to be essentially not turning a profit on these boats. which is probably very, very conservative, to be honest. But that's how I'm going to play this one out, at least for the next couple quarters, year, maybe even a year to 2 years. I'm going to be watching the company and seeing exactly how it goes, and probably upgrading the company as they start to show strong performance within this brand. Likewise, with the capex and depreciation, you can see there's a huge spike up in the capex as a percentage of sales right here. But I do think that's a little bit of an outlier, but considering it's still trying to rev up those revenues, as I was talking about. And as I said, they have a little bit of a lumpy capex cycle in terms of trying to get the facilities in place to produce these boats. But for the most part, they don't sell crazy amounts of units that requires massive amounts of continuing capex in order to continue to put them out. They just have relatively high costs, as you can see, with these relatively high levels of the operating expenses compared to the sales. So this is a little bit of an outlier, but in general, still a decent amount of capex relative to the depreciation that we have right here. We'll see a little bit of a leveling off of that in terms of my own projections for the company. Though it's worth noting, I do project higher levels of capex for the higher level growth scenarios, under the assumption that perhaps they do actually have to make a larger amount of facilities than they expected, thus making it much less profitable. But that's just another way in which I'm being very conservative with this assumption. Now, putting all three together, you can see the revenues over the last 10 years, including all three segments, as well as my projections for those revenues put together for the 10-year forward period. You can see overall, we're projecting pretty solid growth in terms of the overall revenues of the company over the next 10 years, but definitely at a much slower pace than they saw over the last 10 years, at least in our base case assumption. We're actually assuming that potentially even lose revenues in our bear case assumption, and perhaps actually have much more similar levels of growth in our bull case assumption. Taking a look, I also include the operating margins put together for all three of those segments, as well as the estimated free cash flow margin once you take the depreciation and the capex levels into account. And you can see they're pretty closely aligned with each other, only a few percentage points below that over the last 10 years. I'm actually widening that spread pretty significantly based off of, like I said, those very conservative capex and margin assumptions that I had going forward. But in general, you can see that the operating margins that I'm projecting for the company are pretty low relative to some of the margins that they've had over the relatively volatile period. So I am essentially assuming a very, very conservative level, that they have difficulty maintaining the higher levels of margins they've had in some of the years past, and then it's much more like an average of the last few years, which included even the low margins of 2020, which is probably very conservative assumption to be had, as I kind of showed you kind of where that conservatism comes from. And why I'm comfortable with that, especially with a lot of the high growth potentials that they have right here, makes me feel more comfortable, be more bullish on the revenues while being conservative on the margins. And that's true also for the free cash flow levels. The free cash flow levels are probably way more conservative than they need to be, but once we come to take a look at the template for my DCF, you'll see how the value plays out with that regardless. Needless to say, the value actually looks pretty good even under these assumptions, which makes you wonder exactly what the company would be worth under some higher margin and higher free cash flow assumptions beyond that. Now, coming back over to that graph where it shows the share Mastercraft has within the space that Mastercraft reports themselves as being a part of, and comparing that to their future market share relative to this. As I was just saying before, they had about 5.5% in the last few years. And you can see, putting together those assumptions as I had, and also projecting forward for this particular industry at basically a relatively moderate pace that's kind of in line with a little bit of inflation plus, relatively similar to what we saw over the last decade. You can kind of see where the market shares fall under the three different assumptions. I think it's a pretty conservative assumption to be had, especially considering they grew their market share pretty consistently over the preceding decade. So the fact that for this next decade, I'm showing only in the bull case that they actually have gains in market share overall within this overall space, and potentially even significant declines, showing that even if they grow their revenues, that it's potentially actually growing slower than the segments that they operate within. Now, like I said, this is actually me relying on the numbers that Mastercraft themselves project with, and that's not actually how I came up with the revenue numbers. I instead actually relied on projections from those industry reports, which I actually also include right here. It only shows the historic years right here, 2022 and 2023 for those particular reports, and then it's the average between the different reports for the different segments right here. The performance boats, as you can see right here, as I promised before, a relatively small segment that's growing relatively fast. Pontoon boats is here in the red, then the luxury in yellow, and then the green makes up essentially the remainder space of recreational boating, the segments that Mastercraft is essentially not really targeting in general. Then I do include essentially the market shares that they had within 2022 and 2023 for each of those segments, and then also the implied market shares that they would have based off of the revenue projections that I've made. So in general, you can see really just a couple of percentage points for the pontoon boats, and also only a couple percentage points in the future, actually relatively a smaller level that I'm projecting for this. So even the industry reports are projecting higher levels of growth relative to essentially the projected growth that I'm giving Mastercraft himself in both the pontoon and the luxury categories. In the performance boats, as I said before, they have much higher market share, mid 20s, higher 20s for 2022, but more like mid 20s for 2023. And then across uh, the the bear base and bull cases projections that I made for the company, I have it going as low as almost 12% in the bear case, though maintaining their high levels at about 30% in the bull case with a midpoint of about 20%. So I'm pretty conservative on all different fronts and kind of back checking both the market share that Mastercraft themselves projects versus industry reports. I think that kind of makes me feel pretty comfortable with the assumptions that I've made here. Now coming over to my DCF template to see exactly how this puts everything together. In the first couple years, as I typically do, I'm relying largely on analyst estimates for the revenues, margins, and free cash flows. And so then we grow into where my models imply from there. In our bear case, we are seeing a little over 600 million in 2033 or near the end of 2033 because of the offset fiscal year as I was talking about before, which is why I was projecting to 2034 for the record. And then our base case, a little under 1 billion in revenue and a little under 1.5 billion for the bull case. Coming down here, you can see how that depicts itself in the cumulative growth case chart right here. Then for margins, likewise, we're relying on the analyst estimates in the short run, although being a little bit even more conservative than the analyst estimates, to be honest. And then in terms of where we're going forward in the future with that, in the first quartile, a little under 70 million, a little under 100 million in the median case, and a little under 140 million in the third quartile case. Coming down here, you can see how the operating margins evolve over time under these assumptions, the operating income quartiles projected over each of those years, and then the distribution of the operating income as a percentage of 25 different outcomes within the template. Then coming over to capital expenditures and free cash flows, you can see that for the next 5 years across all the cases on expected basis, we're really only seeing an average of about 12 million in free cash flow per year. So you can see relatively low levels for the next few years, which is pretty conservative, and then moving down to actually low levels in kind of the midpoint years right here, only then growing into higher levels of free cash flow, averaging about 40 million and change for the back half 5 years, growing to almost 60, 70 million in the terminal year itself. You can see how the return on invested capital evolves over time within this. They've had relatively high levels of return on invested capital, historically speaking, in which we're going to see growing consistently, but then also starting to come down and level out, which is pretty consistent with what we like to see in our valuations in general. The distribution of free cash flow across 100 different outcomes, you can see right here, well bunched up around 50 to 60 million, but with plenty of potential, like I said, to actually be wrong to the upside. And like I said, I feel pretty comfortable assuming that I'm going to probably be upgrading this company, as it actually shows a lot of my conservative in terms of margins to be unnecessary going forward. Then coming over to take a look at the terminal cases, how that works out into the actual valuations. The implied terminal multiple, you can see we have very largely bunched up around 8 to 9. But there is potential for it to be close up above 10, perhaps even close to 12, though not necessarily a huge amount of cases across all of the 1,000 right there. And then in terms of the actual fair values we end up with, that gets us to an expected case of about $28 per share, a little under $20 per share at the first quartile of our 1,000 outcomes, and a little under $35 per share at the third quartile of our outcomes. So it's hovering, pretty close to that first quartile, but has lots of upside to the third quartile, and that's taking all of that conservatism still into account. Here you can see the distribution of the fair values that I've created here and the expected returns here. And coming over to the final page where you see the summary DCF of all the expected cases across all the base assumptions, currently trading at about $20.50 and change. It's currently trading at the 27th percentile of the distribution we created. Again, that fair value about $28.50 per share, upside of about 38-39% with expected returns of 14 to 15%, taking all of that conservatism into account. Please subscribe to the channel, hit the notification bell, and smash the like button. It's the easiest way to help with the YouTube algorithm. If you'd like to be part of the community, join the free Discord. If you really want to show your thanks and support, there's the PayPal as well as the Patreon, where you can get access to private discussions, early content, and even your own link to my dashboard for looking up my valuations. All links are in the description below. So that's going to do it for my valuation of Mastercraft. As I kind of had already implied relatively early on in the video, I did already take a position in this company, largely based off of a lot of the pricing dynamics that I saw within the space itself. I actually did do a comparable analysis of just within a lot of the luxury brands, especially luxury vehicle brands, though I didn't really want to cover some of those details here since I had a lot of other stuff to talk about. But the point is I kind of was looking at the pricing from many different angles, trying to think about just what brand to maybe take a closer look at within the luxury vehicle space, and that's kind of what drove me to looking at Mastercraft in particular. But I think this valuation is really a slam dunk, especially considering a lot of the conservatisms that we talked about. So I look forward to seeing the performance of this one going forward. That's going to do it for this one. Catch you all in the next valuation. Bye.